Thank you, Ken. I think I had earlier on been introduced. My name is Joseph Rono. I work for CPF Financial Services as a Group Executive Director. And I think we are the first pension fund to have promoted a REIT into the market called Lab Trust Imara REIT. Thank you. It's a pleasure to engage with you this afternoon.
Good afternoon, everyone. I'm Ngatia, Kirungie, head of the Secretariat at KEPFIC. Thank you.
Good afternoon, everybody. My name is Ewart Salins. I work with a fund management company called Apollo Asset Management. Thank you.
Good afternoon, everybody. My name is Mbithe Meuma. I'm the Chief Business Officer at the Nairobi Securities Exchange.
Good afternoon. I'm Frederick Nzui, council member representing the Association of Pension Trustees and Administrators of Kenya.
Thank you. Thank you very much. So we had a presentation. Zorav, are we going to queue it up or do we just go to questions? And maybe we can share the presentation.
It's up to you. You've got 30 minutes. Use them so wisely. So wisely.
All right. I think we'll move to the questions. I think we've all been bombarded by so many slides. I think by now we are probably cross-eyed, but I guess we'll start with the questions then. So the first question I think will be to Rono, and then perhaps so we can hear from Frederick on this one. How can REITs gain more mainstream acceptance within institutional pension investors? So perhaps Rono, then Frederick.
Thank you, Ken. I think there are so many ways in which we can make REITs to become a bit more acceptable to our members by, first of all, explaining to many of potential investors on REITs the basic advantage of REITs. And there are quite a number. Unlike real investment in real estate directly, REITs gives you a perfect opportunity for diversification. You've seen making an investment in a single property can be quite costly, but you can easily get exposure in quite a different arrays of opportunity within the property space by just investing into REIT. So I think those are some of the things we need to shout loud about it. Of course, the other aspect is issues of liquidity. For example, once a REIT is registered, really, you can easily sell units at the stock market. And you can imagine, I know many pension funds are struggling to cut down on exposure, for example. And I can tell you selling a single-story building is not easy. But you can imagine if you are owning it in form of units, then offloading it can be fairly much more easy. And then the other advantage which comes to with REITs that we need to shout about is the aspect of professional management of the underlying assets that is on REITs. And I can tell you from my own experience, ever since we moved our properties into the REITs environment, the kind of analytics, remember this is a listed product, so there'll definitely be a lot of scrutiny from investors in terms of how you're managing some of those underlying assets. So that level of scrutiny alone pushes you to really make sure that if it's a property, you have the best in terms of occupancy, you have the best in terms of maintenance, you have the best in terms of yield. So those are some of the advantages of having exposure on REITs. Thank you.
Thank you, Rono. Frederick?
Thank you. I'll just echo the sentiments of Mr. Rono as well. Given the current global market conditions, pension trustees are really struggling to drive that extra return to their members. We've seen slow growth over the last 2 years, more or less negative returns. We've seen the NSC not really giving much of the expected returns around the equities. In terms of the property portfolios, that has also dipped a bit. Most schemes have more or less slowed down into direct investment in real estate. I think that is coming out of the directive from the Retirement Benefits Authority to have fund managers sign off on some of these property investment allocations. Therefore, pension funds are now looking to indirect investments. We've seen REITs as the space that pension funds are looking into as well, property funds as well, opening up. As APTAC, we have been in a collaboration with the NSC as well as the CMA under the Sanduku Investment Initiative, and we've been able to come together with the Kenya National REIT registration, which is likely now to spur a lot more interest as well. And we're looking to collaborate with the REITs Association of Kenya to drive that conversation moving forward. There's quite a bit of government beta transformation around the PPP financing model. And therefore, we as the pension funds, insurance firms, SACCOs, it's time now to have that drive to drive that conversation around REITs as well.
Thank you, Frederick. So I'll come to you, Ewart. And I think over the last couple of days, we've had the sort of mismatch between fund managers, trustees, and that whole conversation. But perhaps the question is, how can we encourage more fund managers to promote REITs? And also, what initiatives in terms of capacity building can be implemented to drive that growth?
Right, thanks, Ken. I think let's just start from first principles. If the fund manager doesn't understand the product, I don't think there's any way you can actually sell it to trustees at all. And so I've mentioned this before in previous conferences. If you go back to the year 1998, 97, 96, in this local market, guys, when we used to sell equities, the basic metric that we used to sell equities, and Paul's here can tell me, it was the cheaper the stock, the better. I kid you not. If it's 2 bob versus 15 bob, you go for 2 shillings. Why? Because it's 2 bob, right? And those are just very basic measures. And then as the market started morphing and evolving over time, we got a little more complicated. We started looking at more fundamental analysis, and the market really did evolve. So I think what we need to do, and that's with no disrespect at all to the fund management community, I am part of it, is to really educate and build capacity amongst analysts who are trying to understand real estate and truly understand how to analyze real estate. I mean, I've been here I'm the day tours, yeah? But just seeing what we've done for the last few hours shows me like how intense this conference has been, including yesterday. I've just done a fair bit of talking to people around the room, and it looks like it's been quite intense. And if we can do this a lot more with fund managers, with analysts, trying to understand real estate, and then that knowledge can filter down and cascade down to the quarterly trustee meetings that we would invariably have with our trustees, yes? And then you would sort of pass that knowledge down. You'd have your fund managers have conferences every year or biannually. That sort of capacity building needs to be done. But that doesn't happen overnight. That takes time. It takes a lot of time. I was speaking to Andrew Simmons over lunch, and he told me the sort of capacity they have at, is it Green Street? And it's pretty amazing to see how much capacity they've built over years. And he was telling me how much they charge for real estate investment analysis. It's anything between 30 grand to 500 grand USD. We can't afford that sort of money here, but I think we can get to a stage where you've literally trained analysts to a level where we're world class, and then the training can filter down to trustees as well.
Thank you, Ewart. So I'll come to Mbithe. I think it's pretty much the same question. I think just let us know what the exchange is doing to drive sort of investment into REITs, and perhaps also talk about sustainable financing in REITs.
Thank you so much, Ken, and also such a privilege to be on this panel. I'll take a different trajectory. I think we've spent so much time here going through the theories of REITs and the value proposition. You really just need to get to a position of whether REITs make sense or not to you. But this is how I look at it at a more strategic and national level. Today, if you look at the assets under management by the pension industry, about 250 billion is allocated to intangible assets, largely being property. Today, we're in a space where we keep saying that we're getting to the tail end of the Vision 2030, but we're yet to see real enterprise actually emerging. Today, we're in a state where the different sectors in the country are actually all aligning to the better agenda. And for instance, the Association of Manufacturers has a funding need of about 260 billion. This is what REITs do for you. REITs allow you to move the 250 billion into a REIT and release capital. Because we've been able to demonstrate that if you bring a REIT, which Akon has done and which Imara has done, you price it at the book value. So you have a one-to-one. If I bring in my assets of 250 billion, I can easily relinquish 250 billion in cash, depending on how much I want to get from the market. Second thing that then it does, it allows the owners of capital to then deploy that capital into real activity in the economy. How do we then fund SMEs? How do we fund the manufacturing sector? How do we finance infrastructure? Let me put it into context. Today we're in a space where countries are signing agreements with our country, maybe Saudi or other countries, and saying, we want to take up this infrastructure project. They say, we'll put in 100 billion, we'll put in 200 billion. I mean, I'm yet to see us putting up our hand and saying, as the economy of Kenya, as domestic capital and people who are actually pulling funds, this is what we can do. So I don't think it's a conversation of, do REITs make sense? I mean, I really go with my team. Do you consider a REIT? And we're getting tired of that conversation. It has to be a strategic conversation of how do I actually use REITs to release liquidity? And then how do I then take my responsibility as a trustee to allocate that liquidity that I've released into constructive and productive activity in the economy?
Thank you, Mbithe. So now I'll come to Ngatia. I think the next thing we're going to hear about is a REIT clinic, where we'll hear about an existing REIT and some people who are looking at coming into the space. So I think for Ngatia, we just want to discuss the deal book and what you feel a deal book will do in encouraging more REIT transactions, and also maybe you can comment about increasing the speed of sort of access to financing.
Thank you, Ken. From my comments yesterday, I mentioned that probably one of the most important things we have to do is to make REITs and other alternative assets less exotic. And the best way to do that is really to have a wide menu of options, and through that, the market gets more sensitized. Now, one thing you could do is you could have these options or these investment opportunities shown to the market more sporadically and on an ad hoc manner, but that really won't focus the mind. Using the deal book really, or using a deal book, allows you to essentially put together a large number of transactions that are live in the market that will allow the investor community to assess the same metrics across different investment opportunities, and give a better understanding of where each stand versus the other. Remember, the most important thing, or where we want to move towards, is less should we be doing alternatives, but more which alternatives to be looking at. So using the deal book allows you to almost standardize your proposition and be able to show key elements such as your track record, returns, the strategy, any assumptions, everything that we have seen today, the financial summaries and the likes. So using the deal book, the intention is to essentially give each REIT the best opportunity in terms of positioning in front of investors. And that will do a lot in terms of increasing speed, access to finance, because what you do is that when these investors are looking at a live opportunity, you find that nothing focuses the mind better than having real risk on the table. So even when we talk about capacity building, you can do capacity building in the theoretical sense, where you sit down and someone comes and speaks to you for a whole afternoon and you forget everything you heard by the next day. Or you could sit down and look at an opportunity and know that at the end of the day, you have to make an investment decision. Those are two very different approaches that have two very different outcomes. Yeah. So the deal book allows you to essentially not just understand the different opportunities, but also to build this capacity that we keep talking about.
Thank you, Ngatia. So I'm also painfully aware that this is the last panel. So I think I'll stop there with the questions from the stage, and maybe just ask whether there are any burning questions from the audience.
You don't ask them if they had a nice lunch, if they're running off to Naivasha, to Nairobi.
And by the way, the question doesn't have to be
REITs related.
Restricted to REIT investment incubation. I think it's just an opening for, in case you've got something that you wanted to ask, should have asked, would like to have asked in the last 2 days.
It can be as crazy as anything. I'm going to go here first.
Hello. My question is REITs related, and I'm curious why REITs was not an option or an alternative to the 1.5% housing levy. Why not consider REITs as the mode of financing affordable housing? Anyone? Zoro, anyone?
Anyone? The lucky one. I think Ngatia is dying to answer that.
I'll give it a go. It was, and it is. Remember, REITs is simply the vehicle that gives you exposure to the underlying asset. And so how you get exposure is almost irrelevant, right? So from what I understand, the government is looking at various options or we're looking at various options to get private sector capital into affordable housing, including REITs. And I think those efforts would be complementary to the 1.5% housing tax or housing levy, which if you do your calculations and you see how many units they're trying to build in a year versus how much they will collect in the housing levy, you'll see there's still a gap. Now that gap can be filled through the private sector, whether it's through REITs, whether it's through bonds, and other vehicles to achieve the same outcome. So it's not and would never have been an either or.
Let me perhaps may I build up on that?
Absolutely, Mbithe.
So, as you said, the REIT is a structure, and the consideration then is for the 1.5% that goes to housing. It then is taken to the fund manager. But I think the conversations that are ongoing is then, does that 1.5% get allocated to existing asset classes, or is that 1.5% then hived off and geared directly into affordable housing? Once that conversation is then concluded, because there are legal considerations and regards to how does that then come into the fund manager and how is it allocated, once that is done, then the deployment is through the REIT, because then the REIT will be able to connect the investor and the issuer. So if it's a 1.5 that goes into affordable housing, and then the considerations are 1.5 is specifically for affordable housing, it cannot be put in any other asset class, then the REIT structure becomes one of the opportunities that then allows a developer to bring in and allows the pension industry to facilitate that transaction. If they come in through a REIT structure, the REIT structure is then listed on the NSC. If it's listed, it also gives the pensioners the option of liquidity if they need to redeem some of the assets that they might need to do with regards to people who are coming to retire.
Thank you, Mbithe. I think before we come to Rono, the next two people I'm just going to add an extension of that question. I'll just like to let them know that what happens in Naivasha stays in Naivasha. So I think I'll come to Ewart, obviously being fund managers, right? His Excellency, and I think the government has been talking about pension funds putting in X amount of money towards affordable housing. So obviously we know that before pension funds can deploy any capital, the fund manager must approve. And then obviously, so just give us your take on that, and then I'll come to Rono, who sits on the pension side, to also tell us what their feel is on that.
I think you're putting me on the spot here, but remember, you're beholden ultimately to the RBA regs, right? I mean, so since this is Chatham House rules, right? Well, whatever is said out there, no matter what is said, you are still beholden to the law. So you can say we're going to deploy X, Y, Z amount into affordable housing, but you will be beholden to the regulations as we know them, unless those are changed. And then ultimately it's the trustees to say, yes or no. So I think fund managers will be, dare I say, very cautious, extremely cautious before they put money into anything. And bear in mind as well, if you're getting 17-18% in treasuries today, it's a tough call to make. Do you put money into something that's giving less? It's probably a lot easier. You can rest easy with the treasury bill. So these are sort of very conflicting decisions we have to make. But nonetheless, I think fund managers are willing to participate in that conversation. Ultimately, we do want to push the nation forward at the end of the day.
Rono?
Yeah. Fairly the same, but I think if you really want to know who makes decisions in pension funds, it's these guys. And what is interesting on the trustee side is that sometimes you could be looking at an opportunity which could be very ideal for the pension fund, but of course, you don't make that investment decision. And when you push the fund manager so much, he tells you, why don't you put it in writing? And you know that you are now heading into regulatory landmines. Yeah, so I think the key thing is really whether it's those affordable housing. Of course, we know the challenges with affordable housing. Issues of return is really a major problem. That's why many people have really not participated so much strongly, especially the pension fund. But of course, one of the other things which, as a pension industry, we need to look at is what I'll call impact investment. Why is it, if you ask yourself this question, why is it that when you look at those institutions which are investing in our country, they're actually pension funds registered abroad coming to make investments, big investments in Kenya? Why is it that we are not able to do that as a country? Yes, you can chase return, but at the end of the day, in the process of chasing return, what kind of a country do you end up with? Do you end up with a country where we are 90% slums, for example? So one of the things which we need to look at as a pension industry is to look at some of those investments, which is also able to create impact to the population. Yeah, so that at least we all move together as a country in terms of making sure that we're able to ease pain, make the country livable in terms of everybody across board.
Yeah, there's a point that Rono makes which is quite interesting. If you take longer term views, I mean, so since we're just sort of going outside REITs, for the fund managers here, if you look at Kenneth's 2020, well, we have to redeem next year, right? But look at 2027, 2028, and more specifically 2048. That for a pension fund, in my opinion, is a great investment. It's in USD. If you were to look at the asset liability matching, it's a fantastic instrument. Look at 2027, you know, it's only $900 million, well, only, but, you know, it's less than 2 billion, right? And it's done in 3 tranches, 300. It redeems before the 2027 election. I think it's a great investment. So as fund managers, we probably need to start looking at taking a much longer term view. Sometimes fund managers are perhaps very short term in our thinking.
Correct. I think that comes from that quarterly reporting where I think we know exactly what happens there. Chairman Kiprono?
Thank you. Mine is just a clarification on the previous speaker who gave their presentation on governance with specific regard to the role of the CID in the clearance of directors. I think that role is not a moral clearance. It is actually a clearance to ensure that you have no pending criminal charges and that you've had no history of criminal charges. So it isn't a moral evaluation.
Thank you, Chairman, for that clarification. Any other question, comment, query?
Concern? Oh.
I think mine is more from the Fahari experience and the other, I think the FPF. Like, how long does it take when you, I don't know, beginning is always difficult to say when did we start, but on average, how long would it take, like, as using those 3 as examples, when you started and when you're already there? A year, 2 years?
I think, Dr. with your permission, you'll allow me, because the next person we're hearing from, actually the first speaker, is the man himself on the hot seat, Raphael. So I think he'll be best placed to answer that. So if we don't have any other question, Dr. we're getting back to you just now. I would like to close it there. So I'd like to...
Sorry, I forgot to mention something before you close. On you asked on sustainable finance.
Yes.
Maybe I can just quickly comment on that.
Absolutely.
All right. So first 2 things we're doing on REITs. We are part of the incubator program, which means then we give you a neutral space where we can actually help you appreciate what is the process of coming to market, what you need to prepare, and giving you the comfort that before you actually go out and engage with transaction advisors, you're very clear on what you do. That's our key contribution on the incubator. Secondly, on sustainable finance, we've already seen Aecon issue the green bond and leverage on the IFC Edge principles. What we are seeing is an incremental allocation of capital into ESG opportunities. So I think if you're considering a REIT and if you're probably getting into a D-REIT, then the key consideration needs to be green. And Green is simple as I will reduce my consumption of electricity by 20% using either solar lighting or using lights that come off and on depending on when people walk in, or reducing my consumption of water. So I think those are some of the things that need to be incorporated. And beyond that, we've also then been going to the counties and having a conversation of issuance of green REITs, or bringing some of the properties into REITs with a view of making a way to greenify them. So those are some of the things that we are doing. Then last but not least is we are also then pushing the conversation of carbon credit trading, engaging in that, and then seeing how we then use ESG to come up with a product and a trading platform for that. Thank you.